IFRS 16 leases. This is the new stand on leases. It is applicable from 1st January 2019, and it has replaced the old standard, which was IAS 17. It's a very popular topic in financial reporting, in SBR, strategic business reporting, and diploma in international financial reporting standard. And of course, it is a very popular topic in your daily life because this is a standard which is going to have a very significant impact on the financial statements of businesses. So let's first see that what were the issues with the previous standard IAS 17, and then we will see the comparison between IAS 17 and IFRS 16. So let's first see what were the problems with the old standard IAS 17. One of the biggest drawbacks of IAS 17 was operating lease, because the operating lease principle under IAS 17, it actually created an opportunity to do off-balance sheet financing. So off-balance sheet financing under operating lease. Operating lease is kind of a rent agreement. When you get some equipment on rent, you classify it as an operating lease. So you do not take it onto your balance sheet. You just start paying the rentals and on the income statement as, rent expense, and that's all. So off-balance sheet financing, the concept is that a business acquires some asset, they start using the asset, but they do not take it onto the balance sheet either as asset or as a liability. Now, you know that your financial statements, your balance sheet and income statement, they somehow related very closely to each other, because a business has resources which are shown on the balance sheet in form of assets and liabilities. And then business use those resources, and the effect of those, the effect of using those resources is translated into your revenues and profits, which are shown on the income statement. So investors are always seeing that how much are the profits and what were the assets which were used to generate those profit. And you get your ratios like, return on asset, return on equity, and asset turnover, etc. Those ratios. And those ratios, they give some kind of feeling to the investors that how a business is doing good or doing bad. Now, imagine that a business which acquires an asset worth of say $100 million on operating lease, and they do not write it onto the balance sheet either as an asset or as a liability. So it's not an equity. So, when you purchase an asset, either you put your own money, it increases equity and asset, or you get it on credit, you create a debt, so you've got liability and an asset, but you don't take it to the balance sheet. You just start using the asset and start paying the rent. And this asset is working for you. It could be as big as an aeroplane. It is bringing in the revenues, it is bringing in the profits, but it is not shown on the balance sheet. And therefore, the profits on the income statement, they become disproportionate to the assets which are shown on the balance sheet. And it looks like that the business is using very little assets, and they are generating quite significant revenues and profits. So, which looks a very good sign and which attracts the investors. But at the same time, the investors, they do not know that the business has undergone such commitments, such lease liabilities, which they have to pay some contractual payments, because in balance sheet you do not show the contract and the terms and conditions of contracts. So there are some risks which could be very detrimental for the business in future, because business has made some huge lease contracts, huge lease arrangements, for which they have to pay lease payments in future, but they are not reflected on the financial statements. So in the present time, it looks very attractive, but what is going to happen in the future, it is not known, because the users of financial statements, they do not have access to those lease contracts. So this was one main reason. Now the problem is that what is the size and scale of this problem? So a very safe estimate, it says that until 2017, only in United States alone, in US, more than $3 trillion of operating lease assets were there. Off-balance sheet financing was done. And actually, if you talk about globally, it was more than 12 trillion tons. Now, we speak numbers here. We are not talking about billions, we are talking about trillions. So you can imagine that $12 trillion worth of assets are off-balance sheet financed, which means that these assets do not exist on the balance sheet. And there are some commitments, there are some liabilities against, there are some obligations against them, and those obligations are not being reflected. So IFRS 16, the main purpose is that all of these assets, to bring them back to the balance sheets of businesses, so that you put them as asset and you show them as a liability, and how to say, the transparency of financial statements should be maintained. So what is going to happen? Why a new lease standard IFRS 16? Because currently NRS, they adjust financial statements for off-balance sheet leases. So you have financial analysts which are examining or analyzing the performance of businesses. So they know that what the numbers they see from income statement and balance sheet, they cannot rely on them. They need to make adjustments that this business has off-balance sheet financing. So you have you see the assets which are shown on the balance sheet as $400 million, but then there is another $500 million which is off-balance sheet. So you need to adjust for those numbers. What could be assets? Starting from as little as equipment, machinery, plant and equipment, you've got construction equipment, you've got aeroplanes, and you've got ships. Like when we say $12 trillion, you mean big assets. Imagine an airline, they just acquire 10 aeroplanes, they get 10 planes on operating lease. These planes, they do not enter into their balance sheet, but they start earning the profits, they go into the income statement, and you see that very nice profits are coming in, but you do not know what liabilities or commitments do you have against them, because you never show them on your balance sheet. You are just paying the annual lease rentals. So that thing is gone now. It is no more a possibility. So under IFRS 16, companies will bring these leases on balance sheet using a common methodology. Now, what will happen? You know that under leasing arrangement, we have two parties, a lessor and a lessee. Lessor is the one who gives the asset, lessee is the one who receives the asset. So IFRS 16, the significant changes have come for lessees, because lessor treatment is almost the same. The major changes have come with lessees. So what will happen with lessees? That lessees, their balance sheet changes. They have to bring down the asset. You call it right of use of underlying asset. So right of use asset you have to create. What was happening in past, that if an asset had a useful life of 20 years and you were getting it only for 5 years, so business said that the life of the asset is 20 years, I'm getting a lease for only 5 years, it's in my operating lease, because I'm not getting the asset for the entire life of it. I am not going to be the only owner or only user of that. So that understanding is gone. In IFRS 16, you say that even if you are not owner for 20 years, you still are owner for 5 years. Considering that those conditions are met, like uninterrupted use wherever you want to use it. So under IFRS 16, the condition for claiming the right of use asset is that number one is that the asset has to be specific. That's the plane which you are going to get, or that's the equipment which you are going to get, and you have an authority or you have an ability to uninterrupted use of the asset. You decide how to use the asset. So when the asset is specified and when you decide how to use it, it means that it becomes under your control. So if it becomes under your control, that is your asset. Maybe the life is 20 years, but you get control for 5 years. So you need to claim it as your asset for the next 5 years. So that is called right of use asset. So right of use asset, you must take it to the balance sheet. So how do you calculate? Now that's another story, the calculations. But the thing is that for the next 5 years, if you take the asset, whatever amount you have committed, the present value of that amount, it becomes your right of use asset. And then you also create a liability, obligation to make lease payment. So whatever your lease payments are, present value of that, it goes to the balance sheet. So in your balance sheet, immediately your assets will go up under IFRS 16, when you will adopt IFRS 16. So all those operating assets, they will be converted into leases, and suddenly your asset side will go up and your liability side will also go up. And then in P&L, what will happen? Because now you claim it as your own asset, so you start depreciating it, and you will pay interest on that, just like you make lease payment. If you remember from IAS 17 finance lease, you were paying lease payments, interest payments, so they will go there. So in income statement, you are not going to show your rental, you are going to show your depreciation, and you are going to show your interest payments, and you call it front-loaded total lease expense. Front-loaded means that when expense is more in the initial years and it becomes less in the following years. Just like you get any mortgage loan, you get any credit or mortgage loan, in the initial year, although your interest payment is, your total payment is same. Let's suppose you are paying $10 million per year, but in the first years, the interest expense is more. and in later year the principal is more and interest goes down. That's the very common, calculation of how do you make your interest calculation. So front loaded total lease expense means that in initial years your expense is more because you are paying more interest. So companies with operating leases will appear to be more asset rich but also more heavily indebted. So your assets and liabilities will go up. And total lease expense will be front loaded even when cash rentals are constant. So if you see that your depreciation part, it remains same, but interest expense is more in the initial years, and as you move forward the interest expense, it starts going down. And impact on your financial ratios. So there are few things which will go up and few things will go down. Your EBITDA will go up because you are taking away the lease rental and you are putting depreciation and interest expense. And your total assets in the balance sheet will go up. Your gearing ratio will go up because you are not increasing your equity, but you are introducing more liability. So the business will start looking more risky now, because your liabilities will suddenly increase, and gearing is the relationship between equity and debt. So equity remained same, but debt increased. So it means that the gearing will increase. EPS will go down in early years. Net assets, they will also go down in early years because you have introduced more liabilities there. So your net assets will go down, and interest cover ratio, that will go down, and asset turnover ratio will go down. Asset turnover ratio will go down because asset base is more. So there are more assets, revenues are the same. So when you bring these assets into the balance sheet, your income statement will not be changed. I mean, in terms of revenue is same because it is the same asset. So revenues are same, but asset base has gone up. So asset turnover ratio will go down. And similarly, your interest cover ratio will go down. So these are the impact on, on your financial ratios due to this IFRS 16. Now that is a very important topic for, in your financial reporting, which is FR. It is more important in SBR because you talk about the application in the application side of that. And then of course it is very important in practical life as well, because all of these businesses, they have to bring back these assets onto their balance sheets. So this was a very short discussion on IFRS 16. I did not intend to do any calculations for that. Here it was, I just wanted to explain you what are the differences, okay? So IFRS 16 is going to have a very significant impact on financial statement of businesses, because all those assets which usually are significant in number, huge in number, because businesses, they never took smaller assets on operating lease. You can imagine there were millions and hundreds of millions worth of assets on operating leases which were off balance sheet. Now when they will come back to the financial statements, and there will be significant changes onto your financial statements, especially onto the balance sheet.